Welcome to this week's Market Matters weekly video update for Wednesday, the 4th of May. I'm Harry Watt, joined by James Gerrish. We're going to talk about portfolio performance, given it's the first video of the month. Firstly, just sort of the backdrop of indexes. The US market had its worst month since 2008, so you cast your mind back to what happened back in 2008, 2009. That sets the scene for a pretty dour market. How did the Market Matters portfolios perform in a volatile month?
So in terms of to see the backdrop, Nasdaq was down 13% or more than 13%. So that shows you how the technology, higher growthier parts of the market performed. Then the S&P 500 was down 9.5%. The Dow was down less. So it was really the interest rate sensitive stocks that or sectors that we've been speaking about that got hit really hard. This is not new news for Market Matters subscribers. We've been writing about it throughout the month. The Aussie market performed better than the US market. We were down just shy of 1%. Again, it's the composition of our index. So resources, banks, etc. held up relatively well. The small caps were fared a little bit worse, down about 1.5%. And then some of the valued parts of the market performed well versus the the growthier parts, as I just said before. The flagship growth portfolio, it's a growth portfolio exposed to growth themes. It was down 2.6%. For the month. The income portfolio, it's more of a value orientated portfolio. It was down just 0.3%. The emerging companies portfolio was down 5%. The international equities portfolio was down a bit over 4%, and the ETF portfolio was down a little bit over 3%. So I sit back here at the end of April and go, gee, we could have done better, but it was against a very significant backdrop. Obviously, the pin up is the value orientated income portfolio, and the more volatile, the more riskier parts of the market, being emerging companies, fared the worst. So that was the April performance, Harrison.
Yeah, if you were reading the paper this morning, it would have been new news to you that the RBA has finally moved on rates. But in terms of market news, that was sort of a done and dusted. It was sort of baked into prices somewhat. A 25 pip hike was probably a little bit more than some people expected, James, but now the RBA is on the up. Where do we see interest rates going here?
Yeah, I guess you can look at it from two ways. So, I mean, yesterday the 3-year bond yield moved 19 basis points higher after the announcement. So, in January of last year, bond yields were 3-year bond yields in Australia were below 1%. They're now above 3%. So that shows you how the market had been positioning for this interest rate hike. Obviously, they were positioned more for 15 basis points than 25. It was a little bit of a shock. But ultimately, rates are going higher. It's not new news. I wrote this morning that, that we should be focusing on other things. If I look at what futures markets are implying, going out to September 23, interest rate futures are pricing a cash rate at 3.68%. The neutral setting from the RBA is at 2.5%. The average economist thinks it's going to be 2%. We draw on research from UBS. Their economists think that the RBA cash rate is going to cap out at 1.6. So there's a huge variance in markets. But I think the key takeaway is that the market pricing is very aggressive. Rate hikes are baked into the cake. This is not new news from an investment standpoint, so we shouldn't be reacting as if it's a new sort of macroeconomic dynamic that we haven't seen before. We have, and the market's already there.
Yeah, and the RBA is one thing. The banks have already moved their rates pretty significantly leading into this hike. Anyway, but in terms of investing, James, how does that rate hike sort of play into where we're going to put our money in the near term?
I think it's sort of one of these, I think sectors have probably been sold on rumour and can be bought on fact. So yesterday we made a change in the income portfolio. We sold AGL after a really strong run, banked about a 60% profit there, and bought Wesfarmers, which has moved down from sort of 65 down to sort of sub 50. So that's been, those retailers have started to bake in higher interest rates, and the market sold them off ahead of time. Not all retailers will do well, and I don't think it's an area that's going to shoot the lights out. But I think from that income portfolio, that makes sense. Yesterday we cut a really painful position in A2 Milk that we should have cut a while ago, but we've turned it into Treasury Wines, which we think has got a better risk-adjusted performance outlook over the near term. It too has been impacted by what's playing out in China. Banks, ANZ reported today, good result. But we're more of a seller of strength in banks. Resources, we've been writing that we're the signs, particularly from the PMIs, the manufacturing data globally, that's starting to roll over, and resources are susceptible to some weakness. So that's the way we're playing resources. Tech, we've written that we're positive in the short term. We have been for a little while and got that one wrong so far, but we're sticking with it. We think you'll get a short term 10, 15, 20% bounce in tech, and we can make some money out of that. So overall, that's generally how we're playing the market at the moment. Volatile, choppy, difficult, frustrating at times, all those things. But we just got to consistently apply what we do over time, and that's what we'll be doing at Market Matters. Harrison.
You touched on ANZ's first half result out today. It's the first of, three of the big four report their half yearlies in the next few days. Westpac's out tomorrow. Quickly, your top level thoughts on ANZ's result?
Yeah, it was. I read through the result first up, and I thought it was good. Cash earnings were ahead of market expectations. Divvy was 72 versus 70 expected. Everything was, not really new news. Shane Elliott did speak to sort of tougher conditions ahead because of interest rate hikes, but then he went and said that consumers are in great shape with savings rates, and equity in houses really high. So it's understandable that a bank CEO is going to talk down the outlook for earnings after they've just printed $3 billion in profit for the half. So you think about it, you've got homeowners copping interest rate hikes. On the other side, obviously, savers are copping interest rate increases, which opens up more investment opportunities for us. So we've been looking at bond space. We added a bond ETF to the income portfolio for the first time in many years. So those fixed rate bonds, I was speaking with a client just 5 minutes ago about getting exposure to fixed rate bonds for the first time in many years. So ultimately, I think higher interest rates are not necessarily a bad thing. They're priced in the market. The banks are passing them on both sides. And, the ANZ result today probably sets a reasonable tone for the rest of the bank earnings.
All right, we'll leave it there for now, James. Great video. Thanks for chatting to our subscribers about.
Is that a positive feedback on the video?
I think it was a cracker. Got plenty out of that one, James.
Thanks, guys. Speak to you soon.